All right, John, good morning. Welcome to the Family First Live Get to 20K call with the SkyPoint agency. My name is Stephen E. I'm the Senior VP here. Today, I'm going to be sharing with you guys how to sell senior mortgage. It's one of the most intimidating appointments that you'll probably run if you do not know what you are doing. In my opinion, it's my favorite appointment. This is the lead that most people do not want to run. It is my favorite lead because I want to say, it's the easiest sale if you actually know how to set the table. So I'm going to share some stuff with you guys on how I run across these appointments every single week. I'm going to share with you guys what a typical lead looks like. If you guys can see that screen. All right. This is what senior mortgage looks like. So you have a client that is in their 60s, 70s years old. They have a big balance. So this client had a $200,000 balance. Let's just say, husband and wife, they both live, just them two there at the house. Very nice house, actually. One of them's retired. The other one's still working. So how do we deal with this client, right? So Donald and Denise, these are our two clients that we're going to be going through today. So I'm going to open up the financial inventory, and I'm going to explain to you how we exactly sold this appointment this past weekend. So, all right. Loan balance on the loan, $215,000. $215,000. Okay. This was a refinance, 30-year loan. Interest rate was 3.35 is what they told me. They've lived here for 33 years. Okay. House value was $585,000. It was beautiful. 370K of equity. Their monthly payments were like $1,800 a month. Okay. Here's where it gets funky. So we said it was Donald. He's 65. Denise, 62. Okay. Both of them don't smoke. Now, kind of like what we discussed last week, I love explaining the legality of how people die in California, because in most states, kind of like your guys's, it'll be very, very similar. Okay. So I want you guys to understand that. Let me mute the line. Perfect. So I asked Donald, because he was on the lead form, so most likely he was on the loan. So I said, hey, Donald, are you the only one on the loan? He said, yes, I am. I said, perfect. Is anybody else on title? He said, nope, just me. All right. Do you plan on having a trust? Yeah, I got a will. Yeah, that won't do. A will won't stand up in court in California. That's the reason why they're free. You can go to getawill.com for free, right? You can't get a trust for free. Why? Because a trust is a legal entity that stands up in court by itself. That's why they cost anywhere from $500 to $2,000 on the minimum. Okay. So none of these things he had, right? So I said, perfect. Let me explain to you, Donald, what happens when you pass away. The lender, let's just say it's Loan Depot. Loan Depot says, who's on the loan? It's just Donald. Perfect. Donald ain't here no more. So let's go look at who's on the title or the deed, right? Let's see if anybody's on there. Well, nope, there's nobody on there, because guess who it is? It's just Donald, right? Is this house in a trust? It is not in a trust. Great. Let's start the foreclosure process. Why? Because there's $370,000 worth of equity in this home, right? So I tell Donald and I tell Denise, when the banks foreclose on your home, they sell your house for what it's worth, not what they owe. They get to keep the equity, not you. It's kind of like having $370,000 in the bank with like Chase or B of A. Would you leave that with your family? Or would you rather leave it with the bank? Of course, you'd rather leave that with the family. But so many people leave that with the lender in mortgage protection. Does that kind of make sense, Donald and Denise? Yes, it does. Here's the reason why I'm here today, because not necessarily am I trying to cover the entire mortgage. I'm here to protect the equity. And if something were to happen, we don't want Denise to lose the home. Does that make sense, Donald? That phrase right there is how you're going to set up senior mortgage. I'm not here necessarily to cover the entire mortgage. I'm just here to protect the equity so that if something were to happen, the niece does not lose the home and the equity. Does that make sense, Donald? Yes, it does. Okay. So I explained to them the other thing, Donald, Denise, I want you to understand. The bank always wins. They always win. Let me explain to you why. If you have a 30-year mortgage, which you do, you're 65. They gave you a 30-year mortgage. What does that mean? That means they're going to take you to 95 years old to pay it off. Most people don't live past 90. Most people don't live past 85, right? The average statistics of men dying is 82, 83 years old. So the banks know that, and they still gave you a 30-year loan. You know why, Donald? Because when you die and your wife defaults on the home, guess who gets to keep it? They do, right? The other thing is, guess what? If you do live to be 95 years old and you pay off the house in 30 years, guess what they made? They made that interest, that 3.35% over 30 years. They made like $300,000-400,000 on you, right? And then the other thing, well, you don't have it. Well, this client didn't have it, but most people that buy homes have it. They have PMI insurance. What is PMI insurance? That means if you default on the loan and you don't have 20% of your balance paid, they get to put a fee on your mortgage that you have to pay for. But guess what? If you default it, their asset is covered because they had insurance on you. So they had their own mortgage protection on you, but you don't have it for you and your family. Does that make sense, Donald? That's the reason why I'm here today, is because I'm here to make sure that we put some coverage on you and your family. All right. So what do you do for work, Donald? I am retired. Okay. What about you, Denise? I'm a teacher. Awesome. Let me ask you this question, Donald. Are you drawing Social Security and a pension yet? Yes, I am. What do you receive every single month? I receive $3,000 a month. Got it. How much of that is your Social Security? How much of that is your pension? My pension is $700 a month, and my Social Security is $2,300. Got it. So let's just say he had full max Social Security. Great. So let me ask you a question, Donald. Does your pension have survivorship? And if it does, at what rate? Is it a 30%, 50%, 70%, 100%? If they don't know, it's almost never 100%. It's usually like 50, right? Why am I saying this? Because I got to bring this up to Denise later on when I kill Donald off, right? So Denise, on the other hand, she's currently still working. She makes $5,000 a month. She is not drawn on Social Security, but if she was, because she has a chart from Social Security, she would be bringing in like $1,300, $1,400 a month if she was drawing, but she's not yet, okay? Why do I bring that up? Because when Donald dies, Social Security pays the larger of the two. So if he gets 27 and she gets 14, together they bring in 41 when they're both alive. But the moment Donald dies, she'll take the 2,700 and she'll lose hers because Donald is the bigger one. So Denise went from living on $4,000 a month income to just 27, because by the time he dies, she's probably retired. So her check ain't going to be there anymore, right? So if her mortgage is 1,800 and what she's getting is 2,700, yes, she can cover the mortgage, but can she cover the utilities? Can she cover anything else? The loans they might have, the credit card debts, the car payments, right? All the other insurances for their kids and grandkids, or, their health insurance. That's the stuff that you got to ask them. So you have to ask a question that's almost rhetorical. And this is what I say. Denise, if something were to happen to Donald, I'm assuming that it would be pretty tough for you to make it, right? Like it'd be a stretch. The income would be there, but it'd be a stretch because, you go from having $4,100 a month to just $2,700 and your mortgage is 18, right? And she'll say, yeah, it'd be a tough situation for me. Here's what I know. The better questions you ask, the better you get at setting the table. Most people don't set the table very well here, and this is why they lose. So for me, I always ask, Denise, you have a beautiful home that you lived here for 30 some years. Does anybody live here with you guys, or is just you and Donald? It's just me and Donald. Got it. If Donald were to pass away, would you want to stay here? It's a 4-bedroom, 3-bath house, 2,000 square feet, and it's just you. And by the time Donald passes away, you might be 70, you might be 80. That's a lot of cleaning for someone that age, right? And she might say, you know what? You're right. I didn't think about that. I would like to stay here because we've been here for our entire lives, but I might not be able to because the house is too big and the mortgage is too high. Got it. She just gave me the answer for equity conservation, right? Because I don't care what Donald says. Donald might want to pay the entire house off, but Denise says she might not want to stay here. Chances are she can't stay here. We just found out that the income alone is going to be very tough for her, right? So I'm going to keep that in the back of my mind. I'm always going equity play right off the bat. I asked Donald the same thing because, Denise is currently working, so she brings in more money. And I say, hey, if something were to happen to Denise, would you be able to stay here, Donald? Donald said, heck no. There's no way I would be able to stay here because even though he brings decent money, she covers a lot of the mortgage, right? So, all right, do you guys have any current life insurance that's not work related, right? Do you have any life insurance that's not work related? No, we don't. Awesome. Okay. Do you have anything that acts like life insurance? 401ks, IRAs, stock accounts, managed accounts, anything like that? No, we actually took that out to basically remodel our kitchen. Got it. They don't have anything. Perfect. I'm going to ask you a few questions regarding your health. We work with 40 different companies. But depending on how you answer these questions will be how I put you in a type of product. I can insure someone that's 85 and healthy, or I can insure someone that's 40 that has cancer. Okay. So it's a very, very wide range of coverage. Have you, either of you, had any heart issues, heart attack, stroke, cardiomyopathy, congestive heart failure, defibrillators, stents, TIAs, anginas, angioplasties, anything heart related? No. Got it. Anything with bypass, pacemakers, aneurysms, heart valve disorders? Nope. What about cancer? Nope. Do you guys take any pain medication? Yeah, Donald takes a ibuprofen to manage some of the swelling that he has and is like, oh, okay, cool. Ibuprofen. All right. Nothing like Norco or hydrocodone, right? Nope, none of that. All right, got it. Any anxiety or depression? No, but it feels like I have it. Ha, 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 right? Any cirrhosis, hepatitis? Nope. Anything with diabetes? No, we don't have diabetes, right? Do you guys take any inhalers for asthma or COPD? Nope. Anything for like oxygen assisted breathing? I mean, I don't see any oxygen tubes on you, so I'm assuming no. Gotcha. Okay. Liver, kidney disease? Nope. You guys are not confined to a wheelchair because I can see you. Perfect. What medications do you take, Denise? Oh, I take a losartan for high blood pressure. Got it. Besides the losartan, have you been prescribed for anything else or take anything else? Nope, that's about it. Okay, what about you, Donald? Yeah, I take a lisinopril and I take Lipitor. Gotcha. So a cholesterol, perfect. Okay, great. All right, give me 1 second as I run some numbers for you. But just to reiterate the point, Denise, you told me earlier that if something were to happen to Donald, you might not stay here, right? You might not. Like if you could, you would. But if it was too tough on you, it wouldn't make any sense to lose the house. Does that make sense? Yes, it does. Got it. Okay, I know where I'm going to put you guys then. So just like last week, Donald, male, 65, non-tobacco. Denise, I'm putting her here, but I might not run anything. I might because she's the primary breadwinner right now, but I'm going to write it down this way. So for those of you that have your phones out right now, let's make this interactive. I'm going to open the Americo quote. So if you want to go to quote.americo.com. So I'm a big 3 options guy. So anytime you have a client that wants to pay off the full mortgage, if they're healthy, like in this situation, Donald is healthy, right? We can actually run payment protector, right? So Donald, I might go full HMS PP. Yep, that's a P. 215,000. He's 65, right? So what I'm going to do is I'm going to go to Americo's website. I'm going to put California HMS Plus Payment Protector. His age, I'm going to put 65, male, right? Benefit amount based on lump sum, So 215,000. Okay. I'm only going to cover him for 15 years. Why? Because he's 65 and he might have a mortgage that takes him to 80, but he doesn't want to have a payment that long. Does that make sense? Like that's the reason why I bring a 15-year plan a lot of times when you have this type of thing. The mortgage is going to be its biggest in the earlier phases of the mortgage. The first 15 years, the mortgage is going to be bigger than the last 15 years. Does that make sense? So if they're 50, 55, 60, and they want the full mortgage and they don't want a cash back, I'm running a payment protector for 15, 20 years. So in this situation, 215,000, 15-year, and I put amortization because you can't lie to people. Okay. 269.77 a month. Okay. Option number 2, EQT / critical time period. Option number 3, same thing. Okay. So how does payment protector work? I'm going to draw this out so I can erase it in a little bit. Why do we sell payment protector? Why do a lot of agents not like payment protector? Payment protector is 100% a decreasing term. That's why I wrote the word amortization, right? Don't lie to your clients and say, yeah, you have $215,000 worth of coverage forever. No, you don't. You lie to them. Don't lie to them, okay? So this is their mortgage, right? Their MTG. And over 30 years, they pay down their mortgage and their equity goes up, right? Payment protector matches this. It's a death benefit that goes down. So let's just say they pay the mortgage and at this point they die, they pay this part of the loan off. Their sole purpose is to pay the balance on the loan. That's it, right? If you set it up 30 years, it matches almost identical. I like to set 25 because it's a shorter payment, right? And they could qualify for it if they're healthy enough. Not only that, it's a bigger face amount. Okay. So that's how I've always done it. All right. Now people go, well, it's a decreasing term, Steve. It's the stupidest insurance you can sell. I used to agree 100% with everything you say. But here's the only thing. In a mortgage, it always decreases. They don't owe more in year one, or they owe more in year one compared to year 15 or 10 or 5 later, right? The mortgage drops in the loan balance. So in this situation, and only in this situation, does payment protector actually make sense? You get a larger face to cover the majority of the mortgage or all of it. All right. So this is the only time I would ever run it. By the way, I explain it to the client that way. Why? Because if he doesn't want it, which he might not, perfect. I don't care. I'm going to show him the other 2 options. So going back to the calculator, quote.america.com, right? I'm going to go to State, California, and then I'm going to go Eagle Premier Series. I'm going to press create. He's 65 years old, male. And what I'm going to do is I'm going to go to the calculator. I'm going to take his mortgage payment, $1,800. I'm going to multiply that by 12 months. That's $21,600. So I'm going to make easy math. So I'm going to put 1 year right here. And I'm going to put $21,600 natural. Okay, times 2 is 43,200 accidental. And then 21,600 divided by 2 is 10,800 terminal illness. Okay, check this out. This is the reason why we do it this way. So 21,600, I run it. This payment is $136.85 a month. Okay, perfect. So we're going to do the same thing, but on this one, I'm going to do 9 months. So his mortgage, right? 1,800 right here. 1,800 times 9 months, 16,200. Let's just put 16,200 in there. 16,200. So 16,200, and then accidental is going to be times 2, which is 32,400. Okay, accidental. 16,200 divided by 2 is 8,100 terminal. All right. Boom. What's this monthly payment? This monthly payment is $103.59 a month. All right. Now, if I can offer cash back, obviously I would, right? If they're 60 years old, 59 years old, I definitely would offer cash back if they're young and healthy instead of running Eagle Premier. But you got to remember, this is a senior mortgage. Most of the time, these clients are over the age of 60, 65, or 70 years old. They're not getting no cash back. They can qualify for Payment Protector, or most of the time they're going Eagle Premier. All right. So I ran something for Denise as well. So she's same thing. So 12, 9, and 6 is what we ran her. So she is 62 female. So 21.6. Natural. I actually write the entire words out in a real appointment, just to let you know. I'm just trying to save some time. This one was 97.04 a month. Okay. And then that one, 16.2. Run. $73 a month. Then we do 1,800 times 6 is 10,800 times 2. That's 2,100. Oh shoot. 5,004. Natural accidental terminal. Boom. And the whole time I'm doing this, I'm not even talking to them, just to let you know. I like the awkward silence. They're trying to stare at my paper. I have it upside down, covered on purpose. Okay. And then right here, I put equity. And I put 370K. And I put it in a box. All right. So now I flip the iPad over, or not the iPad over, the paper over, and I show it to Donald. I'm like, perfect. So these are the options I have for you. Okay. Donald, kind of like we discussed earlier, right? If something were to happen to you, Denise would be scared of living here on her own, not because of anything else besides the fact that she might not be able to cover the mortgage and the house might be too big for her, right? So I ran an option for you, Donald, to cover the entire mortgage because it seems like that's what you might want. The only problem is I don't think it fits in your budget, and not only that, I wouldn't suggest it for you because at this point we would have to time your death. I don't play God. You don't play God. That's not going to work for me, but it's my obligation to show you anyways. Okay. So to cover your full mortgage, $215,000, it's going to amortize over the next 15 years, kind of like your loan would be $269.77. At this point though, you can cover the entire mortgage just shy of $300. I don't care for it. It might be for you, but if you like it, great, no problem. The plan that I like for you, Donald, is the middle one. Let me explain to you why I like this one the best. Okay. If something were to happen to you, Donald, it's going to give Denise 1 year's worth of your mortgage payments. So 1,800 times 12 is 21.6. Okay, that's where we got this number. If you were to die in a heart attack, stroke, anything naturally health related, the insurance company is going to pay your mortgage for 1 full year for Denise. Now, why are we going to do that? Because the last thing we would want Denise to do is to make a financial decision when she is grieving or absolutely distraught. How long y'all been married? 40 years? Yeah. Can you imagine waking up the next day and not having your loved one next to you after being married for 40 years? It's a nightmare, right? So the worst thing that we've seen clients do is we've seen them make financial decisions based on emotions. That's never a good combination. Does that kind of make sense, Donald? So this plan would allow Denise to make the mortgage payments for at least 1 year to get her affairs in order so she doesn't lose the house. Because currently right now you have $370,000 worth of equity. In 10 years, that might be $450 or $500. That's your life insurance policy right there. And the only way you can access your equity in your home is by selling the house or refinancing. Well, let me ask you this question. If she's not on the loan right now, it's probably because the debt to income ratio or whatever it may be. If she couldn't refi, or she could have been on the loan right now, what makes you think she can be on the loan 10, 15, 20 years later when she's only on Social Security? That doesn't make any sense. So that means you eliminate this option and she's forced to sell. Does that kind of make sense, Donald? That's the reason why this is one of the most popular plans for folks that are over the age of 65. Now, here's the other feature though. If you were to pass away in an accident, anything that's non-health related, which basically means car accident, or let's say you walk down the stairs, you fell, you cracked your head open, you bled, died 6 months later, the insurance company would pay double. So that means they would pay 24 months of your mortgage payments, 2 years, $43,000 and some change. Okay. Now let's just say you were to pass away, Denise were to sell the house and get rid of everything in 6 months. She does not have to pay the rest of the money to the bank. Okay. She keeps it all. We send her the check so she can make the monthly payments on there out of her account on auto pay. Right. So no, you do not have to use all the money for the mortgage. Does that kind of make sense, Donald? Got it. Also, we do not send the money to the lender anymore. Back then, when mortgage protection was sold back in the 2000s, we would put the beneficiary as the lender, because if something were to happen, they would pay off the lender. The only problem with that is, Donald, is that they sell your loan so quickly. So right now you might be with Loan Depot and we might set the beneficiary as Loan Depot, but by the time you pass away, they might have sold it to like Caliber Homes, right? And what happens is there's so many times where the insurance company sends the money to Loan Depot, but guess what? Caliber has your loan now. You know how long it takes for us to get money back from Loan Depot to send it back to Caliber? Yeah, by the time it happens, it's already over 90 days late on your mortgage and they're starting the foreclosure process. So no, we do not leave it to the lender no more. We leave it to your family so they can control everything. Does that kind of make sense? Yes, it does. So if you were to get terminally ill, the insurance company will pay you 6 months of your mortgage ahead of time. What does that mean? That means they give you $10,800 up front to do multiple things. You can have quality life, meaning like if you and Denise wanted to go to Hawaii and have a one last vacation for you to remember, you can do so. If you want to use that money to save your life with treatment, like cancer treatment or a new experimental treatment, you can do so. If you want to just pre-plan your funeral, you can do that as well. Or you can have the mortgage payments ready to go so you can start the refinance process with Denise while you're alive, throw her on the loan, or you can start selling the house right then and there so that she doesn't have to lose the equity. Does that make sense, Donald? It gives you options. The reason why these plans are so popular is because that when you pass away, the last thing we will want Denise to do is make a decision based on having no options. With this plan right here, the one that we like the most, it'll give her a year to make decisions. She has plenty of options, whether she wants to stay, whether she wants to move, whether she wants to have renters, whether she wants to rent the house, whether she wants to rent a room, move in with the kids move in with her, whatever it may be. It gives her 1 year to decide what she needs to do with the home. Now, this plan, Donald, all this that we just talked about is only $136.85. So let me ask you this question, Donald. Would you spend $137 to protect $370,000 worth of equity? Of course you would. Of course you would. Because how foolish would it be to leave this back to the lender, right? And we already discussed that Denise would have no idea where to stay, or if she would even want to stay here. The mortgage would be too tight for her without groceries and all that. There's no way she'll be able to stay here by herself. It would be too tight. She already told us that. Now, if you don't like the 1 year plan, we have a 9 months plan. 9 months does the same thing. It basically covers your mortgage for 9 months. Some people like this feature, some people don't. I honestly think the 12 months plan is the best option, but it's based on budget and we can't push price. So this plan basically is if you were to pass away, they would pay 9 months of your mortgage, which is $16,200. If you were to die in an accident, they pay 18 months, so a year and a half, basically $32,000 worth of your mortgage. If you were to get terminally ill, they would pay you $8,000 up front. This one is just a little bit over $100. It was $103.59. If that's in your budget, perfect. Denise, these are the same plans that we offer for you, blah, 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 blah. And at this point, I basically flip the page over and I say, out of the 3 options that I showed you, which one do you like best? And I shut up. I don't explain anything else. And I let them ask me any questions that they have. And as I circle this like 15 times, I'm trying to make it obvious that that's the one that I like for them. You see what I mean? And when they say, and I'll ask Denise, hey, Denise, if something were to happen to Donald, would a year be enough? Would a year be enough for you to be able to make all the decisions you need to do, like burying him, cremating him, whatever it may be, cleaning up the house? Because here's the other thing, Denise. You know what's the number one complaint that we hear very, very often about spouses living in a home after their loved ones has passed away? Is that it's very, very difficult for them to do anything, because anytime they walk through the house, they just remember all the memories that are going in the house. So they're like, oh, that's the dinner table that we first had dinner with my parents on. Oh, that's the couch that, we would wake up on Saturdays and our entire family would watch cartoons with our kids because they were so young. And that is the part that they don't want to be here, Donald. So sometimes they rather just sell the house. Does that kind of make sense? Yes, it does. So out of these three options, which one makes the most sense for you, Donald and Denise? I like the middle one. Perfect. Let me see your driver's license. We're going to start the application process. That's exactly how I sell senior mortgage. Now, let's just say they want the payment protector. The other thing about payment protector is when you run the quote, they're going to give you a second number, which is like, in this situation, it might be like $1,376.84 a month, right? And you're wondering, what does that mean? That means that if they were to took payment protector, they have two options. They can take the lump sum, whatever it is. It's not going to be $215 by the time they die. Trust me. It'll probably be closer to, like, let's say 180, 150, 120. They can take the lump sum, or the insurance company could pay them that number, that monthly payment, for the remaining of the policy term. So let's say he bought the policy for 15 years. He died 3 years in. They would give them that money for the next 12 years, the remaining term of the policy. Sometimes that number right there by itself is roughly around the same number as the mortgage. It is a good plan. Sometimes she has to supplement a little bit. So in this situation, she needs to pay $400 a month, right? Because of the insurance companies to give her $1,300. Her mortgage is $1,800. She's going to pay like $425 to live in that house. She can do that if she assumes his Social Security at $2,700. Does that make sense? Sometimes that's the best bet. Sometimes it's equity conservation with Eagle Premier. It depends on your client and what their goals are. If they're stuck on paying off the entire mortgage, payment protector is your best bet. Now, here's the thing. I always ask Donald, can you afford $269 a month? If he says yes, I'm like, perfect, go grab me your driver's license. That's the product we're putting you in. But if he says, no, that price is too steep, I agree. I think so too. Okay, so we're going to go with this one, the middle one. Okay, go grab your driver's license. We'll start the application process. All right. Let me see if I'm missing anything. Boom, boom, boom. Yep, the goal isn't to pay off the whole house. The goal is not to lose it. The goal is to protect the equity in the home, right? So let me unshare my screen. If you guys want me to screenshot this, I will, just to have any notes. Does anybody have any questions regarding what I just showed you with senior mortgage protection? You can unmute yourself and ask. I'll be more than glad to go over the questions with you.
Are you available to come on all my appointments?
You can call me from the home. That's what we do here very often. What's up, Troy? Nice to meet you, buddy.
How you doing, buddy? It's good to see you, man.
Good to see you as well.
Glad to be on board.
The thing is, Troy, like when we build a nationwide agency, that's just kind of what we do. I can probably guide you. Like what we say is that financial inventory, gather all the information that you need, and you'll call me from the home, take a picture of it, send it to me, and I'll literally show you how and which product to sell. Yeah. But it's just understanding the concepts, man. Mortgage protection, you're trying to make sure that the family doesn't lose the home. The other thing is sometimes it's not a house with a spouse. It's not a husband and a wife. It's a husband by himself because the wife died or they're divorced. So I'm like, well, who would you leave the house to? Oh, my kids. Gotcha. Do they live with you? No. Are they local? Are they out of state? Do they have their own house? Do they live in a house nicer than yours? Why? Because they're not going to downgrade. So they're not going to try to live here. You see what I mean? What they're trying to do is make sure that if you died, they sell the house, take the equity, and they can just plop it on theirs or keep it. That's your life insurance that you're leaving your kids. You got to just put the options in place so that they understand what they got to do.
What was that term that you used that when Denise is not on the loan, that year plan gives her time to get on the loan?
Equity conservation and critical time period. So that's why I wrote EQT and CTP, equity conservation. We're trying to protect the equity. And then critical time periods, we're giving her 1 year to make critical decisions, right? It's a made up term. It's not really anything. The insurance company doesn't have any of that. It's just, we make it sound like, hey, you have a ton of equity. That's what we're here to protect. If you die, your family loses it. Please don't give them 370 grand to the bank, you know? So that's that.
But when he passes away and she's not on the loan, what does she have to do to get on that loan? Or what happens in that situation?
Many times, if she's not on the loan and she's not on the title and the house is not in a trust, she has to fight to try to refinance that home back into her name, which is very, very odd. It won't happen very many times because some loans are not assumable. So like, let's just say me and my wife, if I was a VA, I'm not, but if I was, let's say I was in, the Navy, right? And I had a loan through the Navy, right? And we were, and I passed away. VA loans are not assumable. Like, that's a fact. Meaning that if I died, my wife has to refinance the loan back into her name because VA loans are not assumable. Some loans are, some aren't. The other thing too is if the bank starts the foreclosure process because they don't need to necessarily talk to the spouse, the only way the spouse can stop that is by going to probate. So their house was worth 500,000+, right? Let's say Loan Depot says, hey, we're going to foreclose on your home. Probate then basically kicks in and says, no, you're not. We're going to send this to court because she should retain the home. But California doesn't do anything for free. It's a 4% probate fee. So $500,000 home, that's 20 grand, right? Not only that, she has to hire her own attorneys, which is another 2-3%. So another 10 to 15 grand to pay. She's going to come out 35 grand to retain a property that should have been hers. So then I explained that to the client, like Donald, and I'm like, do you even have 35 grand for her? No. Okay. So you would want to put her through that though? No. Okay. This is the reason why this policy in place makes sense. Because as long as you're making the mortgage payments for the most part, sometimes they are actually able to just continue the loan. But It's just buying her time. You're buying her time to make a decision not based on emotions. That's what you're trying to do.
Awesome. Yep. That's master right there. Cool.
Anybody have any other questions?
Yeah, I have a question, Steve.
What's up, man?
Okay, well, good morning. My question is, what about a senior that had their person passed away, their spouse passed away, and they're looking more so for their kids, but their rebuttal is, oh, my kids are in a good position, so I'm not certain if I need to do something for them.
Yeah, but congratulations, they're not on the loan, they're not on the title, the house is not in the trust, so you're going to send your kids to probate. Not saying that they can't afford it, but you really want to drag that out for 9 months to 12 months. See, when you run mortgage protection enough, and you'll hear the stories, the horror stories of like families being dragged through the mud through probate. Like right now, if someone had to go through probate right now, because we're in coronavirus, so like the courts aren't open. Like, can you imagine that process? Because instead of a 9-month, 11-month process, it's like 2 years. You want to drag your family through that for 2 years, Donald? I understand, Billy makes great money because you raised him right. He's got his head on his shoulders. Like, I'm not going to bash his kid, right? He probably lives in a very, very nice neighborhood. He has his own mortgage. Hey, Donald, I make good money as well. But you know what I can't do? I can't take care of my mortgage and my mom's mortgage at the same time, though. I know that for a fact. You see what I mean? Like, doesn't mean you want to throw a $2,000 burden on your family, on your kids, just because they're well off. You know what I mean? Like, that's what I would say. And I'm always telling people, like, I don't sell trusts, and I'm not an attorney, but the best thing you can do is put the damn house in a trust. Because all it basically means is when they look at when you die, they go, oh, the house is in a trust. They go grab the trust paperwork. Oh, Billy is the executor and the trustee. We go talk to Billy. Now it puts it in a smooth transition for your family when you die. But if your son is not on the title, which he's probably not, because lenders don't ever do that, he's not on the loan because the dad is not going to screw the son by putting him on the loan if it's not his own house, right? The trust is the only way to go, and you don't have one. So let's put something in place that wipes off the entire mortgage, or pays a portion of it until he can transition the house back into his name.